Hi everybody, Andrew from Capterra here, and today we are going to be talking about inventory costing or inventory accounting methods. So inventory accounting is the way that you account for the inventory that you have on hand. And there are two basic ways to do it. One is FIFO accounting and one is LIFO accounting. FIFO stands for first in, first out, whereas LIFO stands for last in, first out. There's also a weighted accounting method that you can use, but we'll cover that another time. These are the two big ones. To make this a little more clear, let's try and use a specific example. So we're going to pretend that we make ping pong balls. So we have an odd system that we're going to use, but it helps explain the method a little bit better. So in our system, we produce ping pong balls over the course of 3 weeks, and the fourth week we sell things. It's just an easy way to look at the accounting that's going on behind the scenes and not have to worry about the actual ins and outs of day-to-day production. So here we go. First, let's look at our production. Week 1, we make 100 ping pong balls, and plastic is relatively cheap, so we're only spending 5 cents per ball. Week 2, we make 100 ping pong balls, plastic has gone up, so now it's costing us 15 cents to make ping pong balls. Week 3, plastic has gone way up, we're making 100 ping pong balls at 20 cents a piece. So at the end of 3 weeks, we have 300 ping pong balls made, and in total we've spent $40 on our raw material. So we have $40 in inventory at the end of those 3 weeks and 300 ping pong balls to show for it. Now we need to sell these things. So what we do, we go out and we sell to ping pong players, grand national champions of ping pong, which I think might be a thing. So in week 4, we're going to sell these puppies. When we sell 200 and our price for each ball is 50 cents. So we're making a good profit no matter how much it costs to make these things. So in total, we're going to bring in that fourth week, $100 in sales for selling 200 of our ping pong balls. All right, so right now we're at a set of unassailable facts. We have made 300 ping pong balls, and it cost us $40, period. We've sold 200 ping pong balls, and we made, off that sale, $100, period. There's no ifs, ands, or buts about this. Now here's where the accounting methods come into play, because what have we sold? Let's assume we make these 100 ping pong balls and we just fill them into a tub. So every time we make a new set of ping pong balls, they just fall into this tub. Well, at the end of 3 weeks, you've got 300 ping pong balls in a tub, but you have no idea which ping pong ball was made when. So when you're selling them, in week 4 here, you sell 200 of them. Which 200 did you sell? That's where FIFO and LIFO come into play. So for FIFO, that's first in, first out. What we do is we assume that the first ping pong balls we made were the first ones that we sold. So we sell 100 ping pong balls that we made at the very beginning at 5 cents, and we sell 100 ping pong balls that we made next for 15 cents. So in total, we've sold $20 worth of our raw material ping pong balls. It cost us $20 to make those ping pong balls. As a result, we've made $80 in profit, right? Because we made $100 off the sale. It cost us $20 worth of inventory to make that sale for these 200 balls. And so as a result, we now have 80 bucks, which is great. This is a very popular and straightforward way of doing things. You imagine the first things you make are the first things that you're going to sell. And actually throughout most of the world, this is the way that inventory has to be managed. Now, the other way you can do it is you can say that the things that you made last are the things you sold. That's what LIFO does for you. So with LIFO, you have made 200 ping pong balls worth of sales. The first 100 you sold were at 20 cents. Those are the last ones you made. And then the next 100 you sold were at 15 cents, the second to last ones you made. That means that you sold $35 worth of raw material. Now, this might seem counterintuitive. This is the sort of thing that you would get if you're thinking of real-world examples. Last in, first out. Maybe if you're thinking about marble slabs. So each time I sell a marble slab, I need to put a new marble slab in its place in the shop floor. And so I'm going to do that by dropping just another marble slab on top. So in reality, the one that I'm selling is actually the last one that I've put down every time, unless someone buys out the whole stack. But you're not going to want to replace that whole stack every time. FIFO is really easy to consider with milk. Every time you sell milk, you want to sell the oldest milk first. So the first milk you sell is the first milk you got in. With LIFO, we've spent $35 on making the raw material to sell the 200 ping pong balls, which means that we now have $65 in profit. Now, it seems counterintuitive that you can sell $100 worth of things, originally have had $40 worth of things, and end up with two different potential profits. But it's all about the way that you think about the remaining inventory. In this scenario, I've got $20 in inventory left. So I've made a good profit, but the cost of goods that I have on hand is still really high. A lot of the cash of my business is on the books as being sunk into raw product. I have $20 of raw product still sitting around. In this method, I've made $65, which isn't nearly as much, but I've also minimized the amount of cash that I have sunk into the things around the house, so to speak. I've got only $5 in inventory left, because I sold 35 of my original $40. So there's just $5, these guys, week ones, of ping pong balls sitting around. So the reason that you would pick one of these different methods is to either maximize your profit, which you do here, or maximize your cost, which is what you do here. The reason you might want to maximize your cost is in order to pay smaller amount of taxes than you would. LIFO is very American. As I mentioned earlier, the international standard is FIFO, but America still allows us to use LIFO, which is great for people who use it, I suppose. But what it does is it means that you can minimize the profit that you're showing on your books, and that means that you pay less in taxes. It's actually, I don't know if it's a corporate loophole, but it's certainly a corporate trick that people use all the time. Now you can't just switch back and forth between them. You have to pick. You can swap once. You have to pick if you're going to do FIFA or LIFO. You can't do FIFA one year, LIFO the next, FIFA the next, LIFO the next. You can't jump back and forth between them. For LIFO, one of the major benefits is that not only did you make less profit this time, but you'll probably always make less profit, because as time goes on, the cost of raw materials tends to increase. So every time that you're selling this last in stuff, you're selling the more expensive stuff, which means that you end up having a very small amount of inventory on hand because you're selling a big chunk of it, which means that you can have, sitting on your books, this is something that many utility companies have been able to do. Sitting on your books, you have a very small amount of registered inventory. I've only got $5. But in reality, the cost of this material has gone up so much over time that I've got thousands of dollars of bonus material sitting on my books that's kind of off book because costs have gone up so long, and I can just roll this over and over and over. As long as I keep making, say this keeps up, I can keep making 200 ping pong balls to sell and sandbagging this 100 at 5 cents under the LIFO method. And I can get to a point where the cost of making a single ping pong ball is $2. And so even though I say I've only got $5 in ping pong balls sitting on hand at any given point, I've actually got 100 that now cost $2 to make. So realistically, I've got $200 worth of stuff on hand, not just $5. Anyways, before you make a decision about which one you're going to use, and for many small businesses, it's just easier to use LIFO. The tax minimization that you get off the back of it is almost non-existent. It's more hoops to jump through if you're using the LIFO accounting method, and it's also the international standard. At some point, America might get sucked into that, so you might as well be doing it now. But before you make a choice, you should definitely talk to an accountant. Make sure that you get some professional advice specific to your business. If you're looking for accounting material, or if you need to get some accounting software, you can check out Capterra.com. We've got a directory full of it. Thanks so much. I hope you have a great day.